Good evening, class. This is Eric Cornett. This is ENT 630, and this assignment I'm going to be covering the income statement. What is an income statement? An income statement is an important part of any company and reports income through a time period which its headings will indicate. It is also a report that is to be submitted to the Securities and Exchange Commissions. An income statement has four main items. These items are revenues, gains, expenses, and losses. When preparing a financial statement, the income statement is one of three documents used to report a company's performance over a period of time. The other two documents are the balance sheet and the cash flow statement. Another name for this is the profit and loss statement or the revenues and expense statement. The income statement, for the most part, only looks at the expenses and revenues of a company over a set accounting period. When assessing revenues and gains, there need to be three areas of concern. One is operating revenues. Two, non-operating revenues. And three is gains. For the first, operating revenue. Operating revenues come from monies acquired from primary activities. Examples of operating revenues are monies realized from sales of your product or from sales offered in exchange for fees. Two is non-operating revenue. When it comes to non-operating revenues, they are revenues that are gained through non-core activities. These revenues lie outside of the core revenues and are not associated with purchasing and sales of services or goods. These revenues get realized from things like rental income, interest from money stored in banks, or royalties from advertisements placed around the business or property. Finally is gains. Gains are considered income from the net money acquired through other activities. Examples of these are sales of unused lands, an old company vehicle, or from a subsidiary company. The net profit comes from non-business activities and one-time sales. Now for expenses and losses. When assessing the expenses and losses of a company, there are three things that need to be considered. The first is expenses linked to primary activities. Next, expenses linked to secondary activities. And third is losses. Next for expenses linked to primary activities. These are expenses acquired from normal operating costs. Example of this are things such as the cost of a product that is sold, research and development, and other expenses. Some more expenses that are considered primary are employee wages, utilities, transportation, and commissions paid on sales. Expenses linked to secondary activities. These expenses come from non-core business dealings. Examples of this are secondary expense is interest that gets paid on a loan, these expenses are also considered non-operating expenses. Finally, for losses. When the sale is less than the book value, it is considered a loss. Losses can come from things like lawsuits. A lawsuit that can occur from a transaction that comes from outside the parameters of the business's main dealings. Losing money after selling off long-term assets too. For example, if a business sells off a company vehicle that is valued at $2,000 for $1,000, it would be documented that it had a loss of $1,000 in the area of the income statement titled Non-Operating Gains or Losses or Other Income Losses. From revenue to net income can be calculated by using the following formula. Revenues plus gains minus expenses plus losses will be your net income. And if you look on the right, we have an example of an income statement. In this, some of the primary things that they'll have would be monies from sales, cost of goods sold, operating expenses, operating income, non-operating or other interest revenues, incomes from discontinued operations, just to name a few. And finally, the bottom line. The income statement is a tool for helping gain insight into different aspects of a business. Some of the data that can be compiled from the income statement are where the business stands in comparison to other business financially, if there is an area that needs to be assessed for possible loss of money or declining profits, company operations, or management efficiencies. I'd like to thank everyone for taking the time to listen to this video. And here are some of the resources that I use to gather this information. There's a lot of data out there if you'll just take the time to check it out. Okay, thank you, and thanks for any feedback.